Hello and welcome. Um, this here is going to be, as you can see by the screen, it says financial accounting and it's framework dot one. Now, the way this is going to work is it's going to be ad hoc, meaning I'm just going to, just present things as it is. I'm not going by any written script. It's just going to be thoughts in my mind. Uh, this here is framework dot one. I don't know how many parts this is going to take. I'm going to try to keep the videos to about 10 minutes a piece, so however many it's going to take is how many it's going to take. And as I said, this here is just some ad hoc. You'll find this here under the introduction for financial accounting. It doesn't pertain to anything specific in the textbook at this moment in time. However, it should give you a general overview of accounting, financial accounting, I should say. It'll build a framework for you to be able to think about accounting. If you just dive right into the textbook and you start reading and trying to learn, you really don't have anything to reference from. So in watching this as part of like an introduction, it'll give you an overview, a basic framework from which to think about. And as you apply the information in the different chapters, you can come back to this to see how everything sort of fits together. Okay, so let's just get started here. I'm going to, let's see, move down to the next slide. All right, and I'm going to be using a pen. Um, the way I like to think about accounting is I like to think of it like a textbook. Okay, so let's imagine this is my textbook. Okay, um, in a textbook, and let's call it, say, American history. In American history, if you open it up, all right, the front cover is called American history. Okay, so this could be um, the books for XYZ Corp. Okay, and that would be the title of the book. Right? Now, when you open up a textbook, you're going to find a table of contents. Well, the table of contents for the books of accounting is called the chart of accounts. And the chart of accounts is basically just a listing of the general ledger accounts in the books. Now, when you think about the textbook, it's broken up into chapters, chapter 1, chapter 2, chapter 3. And we're talking about, say, American history. Chapter 1 would be like the American Revolution. Chapter 2 would be, let's call it the War of 1812. Chapter 3 would be the Civil War. Chapter 4 would be, I don't know, World War I. And Chapter 5 would be World War II. And when you look at that table of contents and you see those different chapters, you also see different subheadings. Okay. Well, the books of accounting is very, very similar to that textbook in that, your first chapter is going to be your assets, and your second chapter is going to be your liabilities, and your third chapter is going to be equity. Your fourth chapter is going to be revenue, and your fifth chapter is going to be expenses. Okay. And under each section, you have various general ledger accounts. Right? And that's how your general ledger, which is your books of accounting, is set up. You have a listing of the assets, liabilities, equity, revenue, and expenses, and you also have the different accounts underneath it. Now, your chart of accounts, like I said, is like your table of contents where you're going to see those different sections and the subsections. Now, if you think about it, when you are going to write a book, you basically gather up a bunch of your notes, okay? And then you organize your notes, and then you write the chapters. Well, again, the books of accounting are very similar in that your notes are basically the transactions that occur in a business, and you gather them up, and you decide which ones belong where, and then you write that information into that particular section of the books of accounting. So in other words, like let's say for example you have here, um, you know, your assets, And if you have a transaction that's going to affect your assets, well, you're going to look under, which account it's going to be, and then under that particular account, you're going to write the information. Very much like the textbook. Let's say we're talking about the Boston Tea Party. That's your note, that's the transaction. You're going to go to the asset section, and you would look for a general ledger account and enter that information in, very much like the textbook, where you're going to go to, the Boston Tea Party is under Chapter 1, the American Revolution, and you're going to see a subsection there called the Boston Tea Party, and then you're going to write the paragraphs under that particular section. Okay, it's very, very much like a textbook. Okay, so. And I'll show you more specific examples in one of the later frameworks here. Okay, I'm going to actually show different forms and how things post over, and you write into the different things. But right now I'm just trying to give you a general overview. So, our books of accounting is our general ledger, and it's a listing of all those ledger accounts. And the chart of accounts is the table of contents for those books. Now, everything for all of our information is entered into that ledger, but how do we get things into the ledger? Okay, well, every business starts with what's called a general journal, and I'm going to abbreviate it GJE. Okay, and every business starts with one. Okay, now it doesn't mean that they can't have more than one, and every business keeps this general journal. So if it's a very, very small business, and let's say maybe you have a 4-unit apartment building. Well, you're going to collect rents, say, every month. So that's 4 rents times 12 months. So that's like 48 transactions. You're going to pay your electric bill, and your heating bill and your water bill. So that's like another 36 transactions. You might have some miscellaneous stuff. So really, in the course of a year, you're only going to write 100 transactions. So you really only need a general journal to put those transactions in. But if you're a larger business, you're going to have a lot more transactions. And so what you're going to want to do is you want to group them together into like transactions in different journals. Now, popular ones are a cash receipt journal, a cash disbursements journal, and maybe even a payroll journal. All right. Now, the number of journals can be as many as you ever need. I mean, big companies like Microsoft and Google, they probably have thousands of journals. I mean, you think about payroll for Microsoft, or let's say you have a franchise, like Macy's or J.C. Penney. They're going to keep a journal that's labeled payroll, Washington, state, Seattle, Washington, store number, blah, blah, blah. And that's going to be that particular journal. And then they'd have another one for Washington State, Seattle, store number, whatever. Okay. So you're going to have an awful lot of journals, but what you're doing is you're grouping like information together in each particular journal, because this way it makes it easier for you to be able to find the information you're looking for. But for most small businesses, you can, starting out with these journals are good choices. Anytime you receive cash, you'd put it in a cash receipts journal. Anytime you pay out cash, you would put it in a cash disbursements journal. And anytime that you do payroll, you'd put it into the payroll journal. So instead of having, let's say in the course of a month, say 1,000 transactions in your general journal, you would break them out into their respective journals, so that anytime I want to check out this receipt, you'd go to the cash receipt journal instead of leafing through a whole lot of pages trying to find it in a general journal. It's not to say that you can't just use a general journal, right? You can have just one journal, but it makes more sense to break it out. So with that thought in mind, a journal is a journal is a journal, okay? When you're making journal entries, it really doesn't, I mean, it does matter because you're organizing your information. But let's say, for example, you decided to purchase an automobile for cash, okay? Well, you can put it into the cash disbursements journal because you're dispersing cash. But You might say, well, it's an asset that I'm going to end up depreciating, so I could put it in, I would want to put it in the general journal because I know that's where I want to put my depreciating assets. Either one, it doesn't matter, all right? I mean, it does to you as far as organization is wise, but as far as your books are concerned, it really doesn't matter. And the reason why is because at the end of an accounting period, all information that's in these journals gets posted into the respective general ledger accounts. Okay, it's sort of like saying, okay, there was that, going back to the American history, here's the Boston Tea Party. Well, I might take that note and put it over here in the cash into the general journal as a transaction. That's my note. And when I go to post it into the general ledger account, well, I'm going to post it under assets and I'm going to find the specific account and write it in. Well, it's the same thing with the Boston Tea Party. I'm going to find, chapter 1, the American Revolution. I'm going to find the subsection, the Boston Tea Party, and I'm going to write that information in that particular section. Moving the information from your journals to your general ledger accounts is called posting. And all you're really doing when you post is just rearrange the information and grouping it by account. So this way, if you have in your journals, your cash accounts are going to be spread out all over the creation. Okay, trying to find a particular entry is going to be crazy. But when you post it, all of those entries that go to the cash account will be listed under that cash account, so that when you go to look for it, it's easy to be found. Okay. So now we're up to 11 minutes. I'm going to add just a little bit more and then be done with this particular framework. So we have all of our information posted into our general ledger accounts, but we want to take that information and we want to create financial statements. Okay. The two most important ones that we create are a balance sheet and an income statement. All businesses have these two financial statements. Okay, they're interrelated. All right, they affect each other. So we take that information and we'll create those two financial statements. But some other businesses, they might have a statement of retained earnings. Okay, they might also create a statement of cash flows. Okay, these are also two very, very common financial statements, but you can create many, many, many others in a cost accounting situation where you're manufacturing something. You can create an additional 20 different kinds of financial statements. There is no set rule, there's no set number. It all depends upon the particular business. But all businesses have the balance sheet and the income statement. Okay. So I hope that was understandable. Very simple. All businesses have a general ledger. Transaction and a chart of accounts is nothing more than a listing of those accounts that are in the general ledger. All businesses have transactions that they put into journals. From the journals, the information goes down to the general ledger accounts. And then from the general ledger accounts, we create our financial statements. That's really the overview, the basic framework of it. But I'm going to go into a little bit more into the particulars of the framework so that you can, see how everything, interrelates. And that'll be in, the next video and one after that, or however many it takes. Okay, so look for the second video.